Good day, everyone, and welcome to our webinar for August 2021. I'm going to start in America as we usually do, and then we'll go to South Africa. The US economy is estimated to grow at about 6.6% in 2021, which is a remarkable growth rate. In the third quarter of 2021, the estimate is that it will grow by 8.3%. When you think of the size of the American economy, this is a fantastic rate of growth, really enormous. The S&P 500 companies are mostly producing record profits at the moment. One exception is Amazon, which fell 7.6% on Friday because it came in with profits below analysts' predictions. Nonetheless, those profits were up 27% on the comparable period. So that's remarkable. Obviously, this is partly because the S&P 500 is trading at a very high price-earnings ratio, around 45%. So it's discounting enormous expectations of rising profits. And when the rising profits are not quite there, even if they're profitable, it'll still cause a bit of a sell-off. Personal consumption expenditure in America is one of the most widely used measures of inflation, and it's closely watched by the Fed and the Monetary Policy Committee. That climbed 3.5% in June, and that is above, obviously, May's 3.4%, and it's the highest level since 1991. Despite this, the Fed still says that inflation that we're seeing is transitory. The rise in inflation is not going to stay there. It's basically caused by base effects from last year, 2021. But we are not so sure. We believe that inflation may be just the beginning of a rising inflation trend, which would obviously eventually lead to rising interest rates, which is bad for shares. Compensation costs or employment costs are also rising. They were up by 7.7% in June month, which is equivalent of 8.4% per annum. Food and energy prices were up 4%. But the American economy is still powering ahead. Non-farm jobs were created, 850,000 in June, and it's expected that 880,000 will be created in July. Again, this is a phenomenal rate of growth. This could, of course, lead to a more hawkish stance from the Monetary Policy Committee, and that in turn would result in a sell-off in equities. The third wave of the virus, the Delta wave, impacted America, particularly the states in the South where there's been considerable vaccination resistance. But about half of the US population is vaccinated. And quite a lot of companies now, Disney as an example, are saying that it's mandatory for workers to have a vaccination if they want to be on-site workers. More and more companies are talking about this. If you want to work for us, you have to be vaccinated. Obviously, there was a bit of a sell-off on the stock market as a result of fears about this rising third wave of the virus, but those fears seem to have subsided and have been replaced by rising profits in the S&P 500 companies. So we believe that in future it will be very difficult to get a job without a vaccination. And that will probably apply in this country as well. The Senate has just recently passed a $1.2 trillion infrastructure investment bill. If that passes through Congress, which it probably will, considering that the Democrats control Congress, then it will be a further massive stimulation of the American economy. 25%, or roughly a quarter, of S&P 500 companies have reported on the second quarter, and 88% of those companies had earnings well above forecast. Obviously, this is what's driving the S&P 500. The average profit margin is expected to rise to 12.4%, which will be the second highest profit margin on record for the S&P 500. If you look at the chart on your screen, you can see that the S&P 500 reached another record high last night. And in July month, it was the sixth month that the S&P 500 has gone up consecutively. It's obviously hovering around these record highs, made a record high last night, and we believe it will continue in this upward trend. And that long-term trend line that you see there, that's from April 2020, is still very firmly intact. However, we must warn once again that we believe that there is a 10 to 20% correction sooner or later coming. So you need to bear that in mind. We think that there will be some kind of major correction on the S&P 500, which will be reflected on the JSE. When and if that comes, we believe it will be a buying opportunity. It will not be the beginning of a new bear trend. And so you should use it as an opportunity to pick up high-quality blue-chip shares at lower prices. We believe that the US economy will still continue to grow strongly. The PE on the S&P 500 is high at 45, but we think it will go higher. The JSE is running behind other world markets, but should catch up. The PE on our market, on the JSE overall index, is about 16.5. So it's way behind the S&P 500. And it's generally seen as cheap by international investors. All right, let us turn our attention now to the local situation. First, I want to deal with a few sort of political points. The arrest of Jacob Zuma, of course, was the major news. It was a huge victory for our constitutional democracy, a victory also for the rule of law. And that is despite the unrest and looting which followed it. The message to those previously involved in state capture is quite clear. There will be consequences. The message to international investors was also clear, that the rule of law exists here. It was, of course, shaken by the unrest and looting which followed, but that seems to have subsided after 9 days. And we believe that the arrest of Jacob Zuma is critical, and over time it will impact on both our share and bond markets. Of course, the civil unrest is a major concern, but the impact seems to have been fairly short-lived, and we do not believe that there will be a repeat, at least not in the near term. This is not a long-term threat to either our economy or the stock market. The main causes were clearly poverty and persistently high unemployment. And of course, the looting indicates a general disregard for the law in this country. This disregard for the law begins on our roads. In fact, it's been well said that in South Africa we don't have rules of the road, we have only guidelines. President Ramaphosa says that the unrest was an orchestrated insurrection. 12 suspects have been identified, 6 have been arrested, and 4 have appeared in court on bail and then released on bail. Some of the looters were clearly not destitute because they arrived to take looted products away in expensive motor vehicles. The Minister of Defense says that this is not an orchestrated insurrection, but rather a counter-revolution. She, of course, was appointed by Zuma and is probably towing the Zuma line. President Ramaphosa would prefer that it was or has been an orchestrated insurrection, because otherwise the ANC's lack of service delivery and the high unemployment levels will be to blame. We think that it's unlikely that there was an organized insurrection, and there doesn't seem to be any strong evidence in that direction at this stage. From our observations, it was mainly opportunistic, but it does indicate the complete disregard for the rule of law by the looters. It now seems likely that President Ramaphosa will do a cabinet reshuffle. The objective will be clearly to remove more Zuma sympathizers. Gwede Mantashe possibly comes to mind. Ministers who've been dragging their feet. Ngakula, the Minister of Defense, who contradicted him about the insurrection. The Minister of Health, Mkhize, who's been suspended for corruption. Jackson Mthembu, who died. He was a close ally of the president. He was the Minister of the Presidency. He's died. So he has to be replaced. And then, of course, the ministers in the security cluster who reacted too slowly or inadequately to the unrest, they will obviously also be in question. We believe that if Ramaphosa's efforts to reform are not opposed by a strong opposition within the ANC, then that will be in the best interests of the country and the stock market. The big news for the economy this month was clearly the unrest and looting in Natal and Gauteng. 600 stores were looted or burned and 200 shopping malls were attacked. The actual cost is estimated at around 50 billion rand, and most of that money will be borne by businesses, the ones that were attacked, or alternatively their insurers. But either way, it will not be borne by government. Except, of course, that there may be slightly lower tax collections as a result. South Africa's debt is expected to peak at 88.9% of GDP, and that remains very high. The IMF has warned that it is still critical. Tito Mboweni says the budget will not be changed. The impact of the unrest was mainly on perceptions of overseas investors. The primary cause of the looting appears to have been poverty and unemployment. And of course, the government wrongly believes that it can solve the unemployment problem by simply employing more people in government. Of course, this is incorrect. Ultimately, only business can generate sufficient jobs to reduce the unemployment rate in this country. Therefore, it implies that we need high growth. We need an environment which creates business growth. And that can only come from a business-friendly environment. The government is still prioritizing BEE over growth. Destroying or damaging high employment industries has been a favorite activity of this government. Particularly mining and construction have borne the brunt of this. The ratings agency Standard & Poor's says the following about South Africa: inflexible labour market with heavy unionization in both the private and public sectors. And they see this as the major problem in reducing unemployment in this country. Of course, the extension of the lockdown was a blow to the liquor and restaurant businesses, but the measure does appear to have worked. The third wave of the virus does appear to be receding, especially in Gauteng. Companies and individuals have, of course, adapted to the new normal. Many people now work from home, but of course, many small businesses have been lost during these lockdowns. The vaccination rollout in South Africa is gaining momentum. We're now vaccinating over 250,000 people per day, and the government's target of vaccinating 40% of South Africans by March 2022 is looking more and more achievable. By the end of this year, COVID will be substantially behind us, in our opinion. The government decision to pay for people without medical aid has been a huge boost. Of course, only 12% of the population has medical cover, but this move has enabled private companies like Discovery, Clicks and Dis-Chem to get involved. Some people are estimating that 80% of the population will have had its first injection by October, but we think this is a little optimistic. From the 1st of September, vaccinations will be open to everybody over the age of 18. Obviously, the goal is to achieve some degree of herd immunity. But the virus has left an indelible scar. It's destroyed some businesses and benefited others. Particularly, it's benefited those businesses which are substantially online. Ramaphosa gave the poorest people in this country a social distress relief package. It's 350 Rand a month, which will last until March 2022. The cost of this is about 26.7 billion. And of course, to this must be added the 18 billion, which has been now agreed with the civil service unions as a wage settlement. That basically wipes out the extra tax collections which we've received so far this year from the commodity boom. Whatever that extra tax won't cover will have to be reallocated from existing government department budgets. However, it seems probable that the ratio of debt to GDP will stay at 79%, possibly rising to 89% by 2025. The commodity boom should continue, So hopefully the debt level will come down. A major problem, of course, is Eskom. Eskom needs to transfer between 200 and 250 billion rand to the Treasury. But we estimate that the tax boom as a result of the commodities prices rising will yield about 100 billion rand by February next year, possibly more than that. So we should see a significant reduction in the debt position of the country. Of course, following the unrest, the Monetary Policy Committee will be reluctant to push interest rates anytime soon. So interest rates should stay at a low level, at least for this year and probably well into next year. Inflation in June month was just 0.2%. The consumer price index was at 4.9%, below May's 5.2%. This shows an admirable control of the money supply in this country. And of course, it continues to enable us to keep interest rates low, which is what this country needs in the meantime. A couple of other points on the economic side. Toyota's very thinly veiled threat to the Durban municipality that it must control the unrest and keep businesses safe there should be taken seriously. Clearly, Toyota is a very big manufacturer of motor vehicles in this country and a large employer. But it does show the impact which the unrest had on overseas perceptions. Agriculture has been a small point of brightness in this negativity in the economy, a bright spot. Despite mild disruption from the unrest, it's heading for another excellent season. Agriculture accounts for about 3% of our gross domestic product and employs just under 1 million workers. The citrus industry particularly has been doing very well. It's the second largest exporter of citrus in the world, and there's been increased demand due to COVID-19. So that has been a bright spot in the economy. Just looking at the rand, I just want to get the right chart here. Here you can see, this is the rand in the last couple of weeks, and you can see here we went through a risk-on phase, which is what took the rand from its low point here at about 13.43 to the US dollar up to this level up here, which was in the vicinity of 14.23 or 14.30. That was caused by a shift to risk-on in America, mainly as a result of the resurgence of the Delta variant of the virus. Then there was a period of sideways movement. Then we had the civil unrest, which you can see impacted on the rand, weakening it further. And then since that civil unrest came under control, you can see that the rand is strengthening rapidly. In fact, this morning when I looked at the chart, it was at about 14.28. So we believe it will continue to strengthen and will in fact ultimately break this low point here at 13.43 and strengthen even further, which is obviously good news for the South African economy, but probably bad news if you're holding rand hedge shares. Right, a few general points. The president, obviously a big move by him was to allow electricity projects of up to 100 megawatts without a license. This is a massive move in the direction of distributed generation, and it's a momentous decision. It will have a long-term impact on the economy as more and more businesses decide to generate their own electricity, probably mostly from renewable sources rather than coal or some other kind of carbon dioxide producing system. It will have an impact on load shedding, should reduce load shedding as more and more companies do their own generation, and it should create maybe as many as 100,000 jobs in renewable energy projects. So that's a piece of really good news. The National Health Fund is still out there, still being worked on. There's a bill which is coming before Parliament. It's up for public discussion. But to us, it looks like just another area of massive bureaucracy and potential corruption. The simple fact of the matter is that South Africa cannot really afford a national health fund. That fund is expected to purchase services, medical services from accredited suppliers. The objective is to provide everyone with free medical attention. This is a very laudable objective, but we believe it's simply unaffordable for South Africa and will result in another government bureaucracy and more corruption. South African ports are amongst the least efficient in the world. In fact, 4 of our ports are in the bottom 5% of ports in the world, including Durban and Cape Town, which is very scary. This obviously results in reduced exports and lost trade, especially for mining and agriculture. The recent cyber attack on Transnet was a further blow to exports, with the Cape Town harbour basically closed for a week and quite a few ships bypassing that port. All right, let's look at some companies now and talk about individual shares. I'd like to start off by just talking about the property index. The property index has obviously taken a knock. It was already down and then took a further knock. So I'm just going to put this on the screen here with 2 years data. Here you can see the property index. You can see the knock that it took as a result of COVID-19. And then it entered a sort of sideways period here. There was resistance at this level at 288 and support down here at 235. There was an upside breakout over there in April this year. And then you can see here the impact of the looting and the unrest took the market down, took the S&P, the SAPI index down about 5%. But that made certain property shares quite cheap in our view. So that is one of our messages. This is a potential buying opportunity. And we'll draw your attention just now to specific shares which we think are good value. In the meantime, Lewis. We've spoken about Lewis many times on these confidential reports and drawn your attention to what a great share it is. Just like to put a bit more data on the screen. Here you can see the impact of COVID on Lewis. Of course, it's a retailer, and also it did suffer a little bit with the unrest, but not significantly. We wrote an article about this share a while back. I just put a bit more data on the screen here. Pull that article in. There it is. As you can see, there was our article. We wrote it on the 31st of January 2019. And there we suggested that Lewis, which at the time was on a very good PE, was a good buy. Obviously, we couldn't have predicted that there would be COVID-19, but you can see here how the share is now in a strong recovery phase. What we want to draw attention to about this share is that it's now on a PE of 6.24 and a dividend yield of 6.82%. So that makes it an absolute bargain, especially when you consider that this company has absolutely no debt on its balance sheet. In the year to 31st of March 2021, its operating profit jumped by 174% and headline earnings per share was up by 136.9%. We believe that this is an absolute must-have for private investors in their portfolio. The next share I want to talk about is Anglo. Anglo American obviously is a massive diversified mining international company. Just want to point out a few things about it. Here you can see the trend in the share price. The interesting thing about this share is that it reached a low here in March last year at 210 Rand. Since then, the share has moved up very, very strongly. And today it's trading for 677 Rand. So it's gone up by more than 200% in that period of time. Obviously, it's benefiting enormously from the boom in commodity prices, but they pushed out a record profit in the 6 months to June 2021 of $5.2 billion, of which they returned through dividends and share buybacks about $4.1 billion to shareholders. So this has been a fantastic investment if you had it. We believe that the commodity prices will continue to rise, and this company is exceptionally well managed. It's also protected to some extent from the volatility in commodities by the fact that it's diversified across both precious and base metals and minerals. All right, the next company I want to talk about is British American Tobacco. This company is not very popular, especially amongst fund managers, because it sells cigarettes, which is generally seen as antisocial. It's been an increasingly oppressed area of business. There's a lot of laws about it, and they have difficulty in advertising. They get hit with taxes and lawsuits for people who are suffering from the effects of smoking. But the share is trading on a PE of 9.49 and dividend yield of 6.26%, which is very low for an international blue chip rand hedge share. It actually probably benefited from COVID, and the CEO claims that they are moving towards non-combustibles. He's hoping to double the sales from non-combustibles this year. The chart shows that this share is moving sideways. So there's the chart. You can see the sideways pattern. But we think that at these levels it's pretty cheap and certainly worth a look if you don't have any problem about investing in cigarette smoking. The next share I want to talk about is Capco. Capco, of course, is a UK company. It was spun out of Liberty by Donny Gordon, so it was originally started by Donny Gordon. It owns Covent Gardens. Now, Covent Gardens is one of the most visited shopping malls and residential areas in London. Covent Gardens comprises about 94% of the Capco portfolio, so it's all about Covent Gardens. The company, the share is trading at 15% below its net asset value. And as the third wave of the pandemic recedes in London or in UK, we expect higher and higher footfalls in this particular company. I just want to put a long-term chart here. You can see the long-term downward trend in Capco. Obviously, this has been caused by Brexit, followed by the pandemic. But now we see an upside breakout, and we see the share trading higher. One of the interesting things about this company is it has a loan to value of just 18%. 18%. That's way below most property companies, and only 3.4% of vacancies. So in our view, it's a very well-run company. It's very, very low risk, and it is undervalued in our opinion. The next share I want to talk about is Vivo. This is an energy company. It owns 2,200 petrol stations in South Africa and the rest of Africa, mostly in South Africa. It recently bought 230 petrol stations from Engen, which also enabled it to enter 8 new countries in Africa. In the 6 months to the 30th of June, they produced headline earnings per share of 6 US cents per share, which is up from 1 cent in the previous period. The company is growing both organically and by acquisition. What you'll notice here on the screen is that I've got Vivo, and you'll see the strong on-balance volumes buy signal, which we drew your attention to a while back when the share was 16.75. It's now moved up to 21.41, so it's gained 27.8% since that time. Another property share that you should look at is Liberty 2 Degrees. This is a property company spun out of Liberty. It owns 25% of the Sandton shopping mall, and it owns Eastgate and also Nelson Mandela Square, of course, there in Sandton. It's also on a very low loan-to-value of 23%, and it has an occupancy of 96.7%. It's trading at about 63% of its net asset value. We believe that this long-term downward trend that you see here will be broken to the upside fairly soon. So again, we see this as an opportunity amongst property shares which are generally undervalued. Prosus was in the news quite a bit this last month because of this very complicated deal which it did. You can see here that the deal was not well received by the institutions, and some of them have decided to sell out, causing a downward trend in the share price. And then it was hammered further by a decision by the Chinese authorities to clamp down on Tencent's social media and gaming activities. This caused the share price to fall quite sharply. So over the last few months, the share has fallen from 1,937 Rand down to current levels below 1,300 Rand. We see this share as undervalued now. And its results for the year to the 31st of March were spectacular. Its turnover was up 34% in that year, and trading profit up an amazing 49%. This is an incredible result for such a big company. So we think that this is potentially a buying opportunity. You're paying far less than people who bought it in February of this year. Finally, I'd like to just talk a little bit about Mr. Price. This is obviously a very well-known retail operation in South Africa. And what I just really want to draw your attention to here is the fact that over the years it's been a favorite amongst fund managers, but it obviously was hammered by both COVID-19 and the unrest. It still managed to report sales up 8.5% in the year to the 3rd of April 2021. Online sales jumped 64.1%, and there's very strong cash generation. The company is sitting on 4.9 billion rand of available cash. The price-earnings ratio after Ramaphoria, which I don't know if we show here, I just want to put 5 years. Yeah, there you can see Ramaphoria. So the PE ratio at this point was around 30. Then, of course, we had the sort of general disappointment after that, followed by COVID-19, and that took it down to a PE of 10. At the moment, it's trading on a PE of about 20. And we believe that as the South African economy recovers, this is one of the shares that's going to continue going up. And we think it will get back to a PE of 30, which basically implies that the share can climb by 50% from current levels. Remember, when you invest in a share like this, the risk is extremely low because it's a high-quality blue-chip share and very strongly favored by the institutions. So we see a potential gain coming in Mr. Price. Okay, folks, that's about all I have for you today. Thank you very much for listening to me. I hope some of it was of interest to you. Otherwise, we'll talk again next month on the 1st of September, I believe is the first Wednesday of next month. So I wish you good investing until then.